If they were to bring down the interest rate along with Canada, how's that going to affect Canada? Would that affect Canada? Would that affect us in any way if their interest rates are going down as well? Or does that kind of have no bearing on our interest rates, our economy, or anything at all?
That's a good question. So, what it has to do with is when I said before they had to choose between the currency or they had to choose between the consumer. So, if you think about it, that if you could invest money in Canada and our interest rate is lower, but then you look at the United States and their interest rate is higher. Like if you look at T bills, because so look at short term investments. So we're at 4.75, but they're at 5%. So if you're an investor thinking, well, where am I going to invest? And I'm simplifying this. So then you might think, okay, well, I'm gonna invest in the US. And so what that does is it causes a demand for US dollars, which increases the currency. And then it creates less of a demand or a sell off in Canadian dollars, which reduces our currency. So it's what they call sort of capital outflows. So if there's a large difference in our currencies, sorry, in our interest rates, it's going to affect our currency. So having a weaker Canadian dollar for the fact that we are primarily an export nation in some ways might be good, but also in terms of importing goods, because we do import a lot of goods into Canada, then that the fact that we have to pay US dollars is also inflationary pressures, right? And so the whole reason why we have this very high interest rate environment is because the economy was overheating and the Bank of Canada was trying to slow everything down. And the way they slow everything down is making money super expensive.